Hey everyone, Douglas here, Kind of Market Analysis, and welcome to the weekly LE Wave update for Wednesday, October 2nd, 2019. It's 10:26 p.m. Eastern Standard Time as I get things started this evening. As I mentioned in the past prior updates, I accidentally deleted the layout, and I've been playing with a few different ideas in terms of what things will look like. And I think I kind of like this and might end up sticking with this. Anyway, aesthetics aside, just so you know, if things kind of keep changing, it's just because I'm playing with whatever whatever I like. So, but not that big of a deal. Obviously, the content is what matters, and that is what we will dive into right now as we get rolling with the charts. So tonight we're going to take a look at the kind of normal lineup of equities. I also want to take a look at emerging markets and the Eurozone, some different levels that might be worth keeping an eye on if things begin to deteriorate even more. I'm not necessarily expecting that. We'll talk that in just a second, but I do want to get a large take on kind of the global outlook right now. And then we'll finish off with gold, dollar index, bonds, and oil. So anyway, let's dive into things here. I've got the long-term S&P chart up, and a couple things I want to talk about. One, just to take a step back and just kind of think about where we're at. You know, one of the things I've been mentioning for a while now is just to prepare for October, and that I think we could see some turbulence as we enter October. I thought that it would be not quite as severe as what we've seen so far. I definitely wasn't expecting a 1.5%, 2% down day like we ended up getting. But nevertheless, selling was definitely something that I thought we could see in that first week of October. And then finally, as we get out of that first week, we could start to see a rally emerge. And the reason for this is because of really the inability for the banking system to digest the massive amount of reserves that come in at the beginning of the fiscal year, and then the sudden stoppage right after. So it, as the fiscal year ends, you see a lot of kind of pickups in reserves. So by reserves, what I really just mean is you get new government spending that comes into the banking system. And this it makes sense that it follows, or that you get this kind of pattern near the end of the year where you get just a lot of sudden peaks and then big drop-offs, big peaks and then big drop-offs once again as new budgets come in and new spending items come in. And then on top of that, you get just your common, Medicare, Medicaid, Social Security payments as well, and the other kind of big government line item payments. So you get a convergence of cycles that usually happens at the end of the fiscal year and into the new fiscal year. And that's exactly what we saw. And in fact, what I use is kind of what I call fiscal flows, or kind of net new fiscal money that's coming into the economy. So that's going to be essentially net withdrawals. So that's withdrawals on the treasury statement is actually the money that's coming in or being spent out, the spending. If you take that minus what I call cash redemptions, which is really just what gets counted in withdrawals that really aren't part of withdrawals. So if you get that equation right, you can effectively account for how much money is in the economy or coming into the economy. And for October 1st, which is the most recent reporting day that just got printed, for October 1st, it's the largest day that we've seen since August 1st. And it is no coincidence that on August 1st, and around that time period, so August 1st was right here, that we had some big selling. And in fact, August 1st, and then I think it was August 2nd before, so that was the Thursday, Friday, we got a lot of selling right around that time period, as those dollars that are coming in and become reserves to the banking system, that fiscal spending hits kind of creates some turbulence in the banking system. And then what ends up happening is ultimately the banking system has to deal with that new influx of money coming in. They have certain regulations that they have to hold, and different levels they have to maintain in their books, and part of that is sometimes they have to sell risk assets. And so that's what I think we saw today. I'm not going to buy too much into kind of any other explanation, because simply put, the explanation is there, it fits, it's exactly what we saw in the data. And I certainly don't think this is a sign of some major deterioration of the economy as a whole. With that being said, I know the ISM manufacturing number came out, and that was certainly a lot deeper than I thought it was going to be, and definitely the market was anticipating. And I'll just say one quick word on that. I'll probably make another video to dive into this a little bit more, but realize that it is a survey, so there's sentiment built into that. It's not necessarily a pure measurement. I certainly wouldn't want to undervalue its I guess or maybe undermeasure its value, but it is a survey and we need to keep that in mind, and the non-manufacturing number is coming out tomorrow, so let's keep an eye out for that and see if maybe some of the trade war stuff is really just weighing down on the manufacturing side, and that is kind of what brought upon that number. So yeah, with that being said, I still think, I mean, all that in mind, I still think as we kick things off here on the charts that a bullish count, and in fact a pretty bullish expectation going forward into the end of the year and then into the beginning of 2020 still should be our MO, and I'm not persuaded that this is the beginning of any big selling cycle. Could we get a couple more days of kind of intense selling, some kind of whipsaw selling? Yeah, I think we could, and I think we're going to take a look in just a second at some potential ways that we might want to count differently what's happening. But with that in mind, I do think eventually we are going to emerge higher here after this 2-year long consolidation cycle, and ultimately break higher. If anything, from just a pure chart standpoint, from kind of a fractal standpoint, this is starting to remind me of what we've seen in that dollar, in the dollar play, as that thing is consolidated, slowly just making its higher high, higher low, higher high, and I think eventually, as this thing consolidates higher, things will eventually catch. And we'll push higher, especially too, going back to that whole reserve explanation. Once those reserves enter the system and finally get in there, that is support for the entire economy, which we talk about quite often in those macro updates. So anyway, wanted to make that kind of make that statement. I know today's selling was probably a little bit more than I was expecting, and definitely not. Yeah, again, I think my call was that we'd come down to support right around 29.40. Obviously, we broke that, but I'm not terribly worried about kind of that extra percent lower that we've got, and I still think we could go a little bit deeper. I think we could tap the 200-day moving average one more time before we go ahead and begin our ascent upwards. So let's talk those counts here real quick in terms of kind of what we're looking at here. I'm still going to keep this as intermediate wave 1, 2, and the big change though from there would be minor wave 1, and the question we're going to have is minor wave 1 complete here? In other words, might we end up eking past this? It certainly wouldn't be within my expectation, but maybe there might be a reason to believe from a pure structure standpoint, right? That we really shouldn't be considering this as some sort of 1 wave, 2 wave, but instead that we could go a little bit deeper. And I definitely will expect some more selling. At the very least, it's hard to get a day like today without some follow through to at least build a bottom and move up, unless we get rocketed back right away tomorrow and we get just a straight V sell off and bounce. Could happen. But a day like today, obviously a lot of bearishness, and usually we like to see that kind of divergence form in the RSI, momentum wane, and then push higher. So if we were to go lower, especially if we were to get lower than 2768, maybe as we approach that, we would want to think of a possibility of this being a 0 A, B, C move. And I'd mentioned some concern about the wave pattern here, just not exactly looking in any way impulsive. In fact, it looked kind of like an ABC pattern with this big flat pattern in the middle now that we're selling off. So this could end up being some sort of a zigzag pattern for a wave 2 in Elliott terms. If we were to get deeper, again, I can't really envision us getting the extra, what would that be, like 3, 4, 5% deeper to get there. But from, it'd be almost 4% to get to a lower. Again, I'm not seeing it happen, but we have to take that into consideration just based on the chart pattern as a whole. Otherwise, if we don't get lower, the question is what to do with the wave structure that has formed from here. If we just simply toss on, let's just say we want to do something like this, right? We want to say, we'll take this off, and we'll say minute wave 1. And then we'll say minute wave 2, and then we'll say minuet wave 1, 2, 3, 4, 5. And going forward from there, well, this just looks kind of ugly. One, you have a very ugly 1-2 stack here. We'd expect at least minute wave 1 to break above minor wave 1. And then on top of that, now our pullback would be much deeper than the 61.8% unless we reversed immediately. So I'm saying all this just because the chart pattern isn't really telling its secrets quite yet. I guess you could say there's still more to the story, and I definitely want to keep my expectations open that we could get a little deeper here, and that the minor wave 2 wave could end up finishing here as just kind of a more extended it would end up being zigzag wave pattern here for a 5-3-5, since it does look like we're pricing out an impulsive wave at this point. So some different options here to play with that could end up unfolding, and of course we'll look at some other charts as well to see if there's any convergence or just any sort of parallels between them. But I think if I had to just absolutely bet on one of them, it would be something like we get something like this. Again through the next week or two, and then finally bottom out early next week, and then start to rally up. And if that were to be the case, then and we never broke below the low that was on August 5th, and I'm just going to say it's a minute wave too. I'm sorry, it would have to be the low on August 26th, and I'm just going to say that it's minute wave 2. All right, so looking at the NASDAQ now, and we broke down from this little channel that had been established, and maybe more so than the S&P. I think the NASDAQ will have a higher likelihood of breaking the lows that we saw back on October, or at the beginning of August, and likely then print out what would end up being an intermediate wave 2. Again, the NASDAQ, or just remember the NASDAQ, everything is one higher degree level because of the fact that all the way back in 2008 we never made a lower low. So this has been a more protracted, extended wave cycle here. So to fit everything incorrectly, we have to bounce everything up a degree. But either way, the structure still remains what it is. So I do think we could end up pushing lower and getting intermediate wave 2. Again, kind of a sloppy looking wave structure here, not your classic 1-2-1-2 setup. Nevertheless, it's what fits, and it kind of makes sense with what the expectation would be. And I do think once that occurs, we would begin to emerge to the upside. Again, kind of following that like dollar index pattern like I was just talking about a second ago, where we just slowly consolidate sideways upwards and then eventually break out into a rally. So yeah, I could definitely see us falling another couple percent here, maybe tagging so about 2%, maybe tagging the 200-day moving average before we move up, keeping that as a real possibility. If we didn't, that would obviously be okay as well. This would just end up being a very sloppy one wave for the minor degree wave series, and we push higher. But again, there's kind of enough technical damage done where it seems like this market wants to sniff out the 200-day moving average one more time. One of the other markets now, as we move on to the Russell here. The Russell quickly, this was kind of looking like the darling, if you will, and has quickly reversed. And I had to kind of clean up the chart here because it seems to me that this flag pattern is going to make one more stab at the lower boundary here. So just kind of extending the wave count, and it would make sense then that we got back below 1455. So and tagging the bottom line. So a couple charts that definitely look like selling's not quite over. And again, just looking at the S&P, likewise, doesn't make sense that the selling's over based on just a pure kind of momentum standpoint, that these things like to bottom out after big sellings, after kind of big selling like this. Very similar, if you will, to what happened just about a month ago. Granted, though, back in at the end of May, early June, we did see kind of the V response, but or the V bounce, but without not exactly the severe selling that we saw. Maybe a more likely parallels. I just look at the chart here would be something like February of 2018 when we bounced on that kind of V form where it only took a couple more days before the bottom got in, and then we started rallying. So needless to say, extending the B wave here, and during the last update I had this as a 1-2. Technically, we could still get that if we rocket off from here, but that seems pretty unlikely at this point. Again, going back to and referencing what I've just spoken about, that the momentum's probably going to want to take us a little bit lower. Moving on to the Dow Jones, again, just kind of showing the general idea as well. I'm kind of putting this into perspective so you can see the longer term count, that that we're probably going to want to challenge the 200-day moving average again, and that this could end up being a zigzag pattern one more time before we push higher. So now I want to take a look at emerging markets and kind of the rest of the world, Eurozone. This is where things get a little worrisome to me, just because you're going to see both the emerging markets and the Eurozone patterns that are emerging that you definitely don't want to break down. I guess it would be the best way to put it. I think you could easily count, right now I'm counting this obviously as an intermediate wave 1. That is definitely where we're at. And I thought we'd have an ABC for 2. And then we would move down, and it would be the C wave that would correspond to kind of the blow off top for U.S. equities. But we just continue to make lower lows and lower highs as we push lower. So not the prettiest looking chart pattern here. And if selling picks up and maybe some of the more bearish scenarios play out that I was talking about a second ago, I wouldn't want things to fall much below, say, 38 here, right? You'd have some support there. You'd have this kind of long-term trend line. And if things start to fall below that, that gets scary. It certainly does. So what I'd be keeping an eye on as this plays out, and this is kind of a scenario that I want to keep in the back of my mind, is something that could play out that could certainly create pressure in the U.S., regardless of what I think right now is a pretty good kind of monetary fiscal situation, is if we start seeing a big rally in the dollar, which has kind of started to take off. Maybe we'll take a look at the dollar. We see oil start to sell off, which we kind of have, maybe not quite to the extreme, but if we see those two things starting to converge, and we're seeing some pressure in emerging markets and in the Eurozone, that's going to get me worried. It'll definitely throw up some red flags, and maybe make me take into account a little bit more risk in U.S. equities, despite what I think is an overall strong macro looking solely at U.S. data. So that's why I'm keeping a close eye on EEM. I definitely want this to catch at a reasonable level here and start to push back up, and any real big fallout here certainly looks like then maybe a wave 2 right here. And I'm saying all that based on the overall count too, within we'll go here within the long-term structure as well. I just think that the counter trend move from the lows in December of 2008 is complete, and the January high, and so I do think we are slowly carving out a move lower that eventually will recreate kind of a 2008 scenario for emerging markets. Again, I think the U.S. is in a bit of a stronger position here, but for emerging markets, we could see some very heavy selling in a year or so. So maybe even sooner, I guess, at this point. So that's kind of the worry that is kind of in the back of my head, or just a chart at least that could indicate something worse. And so worth keeping an eye on there. Looking at the Eurozone chart as well, and again, same idea. Let me just move out to the weekly chart real quick. I do think this has been a counter trend move, meaning that the predominant trend in the Eurozone is still down from an Elliott perspective, right? This is the A wave, this is the counter trend B wave. So the trend from at least a technical A wave perspective is still down in the Eurozone, and it looks like a complete wave here to me. I mean, you could make the case for an alt account that pushes up slightly higher, but that case is starting to deteriorate kind of right in front of us. And again, I'm going to move this back into the daily chart now, like the emerging market, the emerging market chart. It's going to get really ugly if we break down from where we found support last time, say right below 3650. If we get below 3650, that's going to look pretty ugly, and this is going to look like a pretty ugly pattern here if we start pushing lower, and especially if we get below the bottom trend channel here. So some things to keep an eye on where we catch, and that this might be an early indicator of a chart that's just breaking down. But again, I still remain bullish on U.S. equities as a whole, and I'm going to allow a little bit of a divergence from U.S. and the rest of the world based on kind of some of the theories I've thrown out there with the dollar strength, what that does to U.S. assets as a whole, U.S. equities as a whole. But this gets concerning from a purely chart Elliott perspective, that it looks like we could be in the early stages of a wave 3, and eventually that wave 3 will break. And those wave 3s can take a while to get together. If we look at, say, well, I could probably pull this up in the daily, it might make a little more sense. But if we look at what happened back in 2008, if I get there, the C wave in and of itself started all the way back in October of 2017, and it wasn't until August of 2018 where we finally saw the entire thing absolutely break down. So pretty much it can take some time to emerge, and kind of like maybe more similar. It took even though we started the selling, and I guess the parallel I'm seeing here is from the either April or August kind of double top high. We had initial selling, and then we had kind of the counter trend move, and I guess that's the parallel that I'm seeing, say, from EZU. The pattern, the counter trend pattern is done. We've gotten the first wave in, but now when is the second wave going to get in, and then when does the final big move begin, so that it can just take a while until we finally get that month or two period where everything just falls apart. Let's see. Let's move on now to, and again, I think the main thing, I know I probably emphasized this, enough already, but I do want to emphasize these are just charts that I keep a close eye on because they indicate what to me is the riskiest element of the global economy right now, which is really the rest of the world, the non-U.S. Entities, because of their large dollar-denominated assets and the exposure they have to that, and the amount of kind of debt fuel they have, or the debt-fueled growth that they have relative to the U.S. So that's why I keep an eye on these charts as kind of a risk indicator, if you will. So let's move on to that gold chart, and again, just kind of looking at the chart here and getting our bearings. Speaking of counter trend moves, I'm still under the impression that what we've had from the late 2015 lows to where we're at today is a counter trend move. And so far, at least in terms of the last couple of weeks, months, if you will, it's operated very much as we expected, bouncing into that slightly above 1500 zone, and we have found resistance. Now, I made it pretty clear that I think that that we could be still possibly carving out a fifth wave here. It makes it look like we might be making an attempt to do just that, but I do think it will be short-lived. I'm still going to kind of stick by that. However, I will be interested to see if gold can really get past this 1500 mark as we back test this zone, because we kind of carved out this head and shoulders idea. I think we had talked about this during the last update with the neckline here, and we're kind of back testing that area. We're a little bit past kind of that normal back test zone, but nevertheless, is this more than just a back test? And tomorrow we're going to resume the trend that looks like it has played out, or are we going to hit the fifth wave? Either way, it is definitely looking like a complete wave structure is almost in or very close to being in. So it looks like a complete structure. If we were to get a little bit higher here, kind of, especially if it's immediate, it would make sense that it would at the very least take time to move sideways or sideways lower before we were to move higher. If anything more is to come of the rally that started, back in August of last year. It also wouldn't be part of my overall expectation. So I do think we are definitely near or in or have already completed a topping pattern, and I think it's going to be quite a while before we make any move higher here. And I think there could be a pretty good chance that, in fact, the next leg down, the next major leg down, similar to what occurred back in 2011, through 2015, might be underway here. So we'll want to keep an eye on that. With that being said, I'm not overly bearish on gold either at this point. we're not seeing yields operate exactly kind of the way that I thought they would. So I still think yields are lower than inflation. And I think that creates a good environment for gold as a whole, but it certainly seems like the rally that we've had, the chart pattern that we've had, is completing, and it wouldn't surprise me into next year if kind of the narrative reversed and we saw rates kind of at least get back to close to where they should be, and that would be a difficulty for gold to continue, especially in light of what we're about to look at now, the kind of rallying dollar. So as has kind of been the case, we had a big, what looked to be ready to be burst in the dollar index, only to fizzle and quickly reverse on some bad news, some bad data. However, the chart pattern remains intact. I mean, despite all this overlapping craziness that we've seen, the chart pattern remains very much intact, and I still very much expect that eventually we'll see a big rally here to reach our at least 109 target, and that 109 target is the target from the measurement of minor wave 1 to minor wave 3. So that would be kind of our baseline target here, 109, 110 on the dollar index. And as long as this kind of trend line here holds on, I have to just remain bullish from even a technical pattern. I know these reversals kind of can get frustrating. Someone who's heavily long the dollar here and is a really kind of key component to the to my portfolio as a whole. But yeah, this remains to me looking like a relatively bullish chart with a still bullish count here, and it hasn't failed us yet, despite coming close. It still hasn't failed us yet. So yeah, I'm gonna remain bullish here on the dollar as a whole, and I think eventually, I know I've been saying this for for quite a long time, but eventually I think we should see some activity similar to what occurred either in 2014, 2015, or maybe even more moderately in late 2016 into the early months of 2017 play out with those sort of moves. All right, let's move on to oil real quick, and yeah, we continue to remain in this consolidation zone that we've been talking about all the way since back in April. Kind of a little bit of sell-off on weaker than expected inventory report. And I guess the big thing is, from a purely technical pattern, the fact that we had this kind of nasty falls breakout after the Saudi Arabia news, and now we've been selling off, it doesn't set up too well. In fact, it kind of, to me, looks a little bit like what played out after the Trump election, right? Where we got this big rally, and then just bam, we got the selling. So again, purely chart. I'll talk kind of maybe more fundamentals in just a second here, but from a chart pattern, that looks like a very false breakout here. So the red count still remains very much intact, and it's certainly looking like oil might want to break down here. And I've mentioned this in the past. If oil breaks down, that is going to be kind of a worrisome sign for the global economy as a whole, because that would give me really what I want to see in terms of knowing that kind of the global slowdown is actually hitting where it hurts, if you will. And when we get some severe selling like we saw back from 2014 all the way into 2016, and then more recently at the end of 2018, that is indicative of dollar shorted stuff, right? Because you get your emerging markets countries having to sell, the oil-rich emerging market countries and other kind of just any country that is denominated in a lot of debt having to dollar-denominated debt having to sell any oil reserves that they have to get the capital raised. So keep an eye on that. As it stands right now, again, chart pattern-wise, certainly starting to look a little bit more bearish, but nothing that you can really sink your teeth into. So I'd wait and see for just a real clear break below, say 51, with some legs behind it to really want to confirm that anything more or any more selling is really going to be behind this as a count. From a longer term perspective, if that were to break down though, just to kind of put this count into perspective. I would have this again as a wave 3 and intermediate wave 3 beginning to unfold, and that does fit in kind of the longer term cycle picture that eventually we will get a sell-off in oil, and that's definitely what I've been expecting again in the future as the cycle ends. And so that's why I'm very curious to see if oil can give us that early indication of some stress in kind of global dollar markets as a whole. All right, let's finish off with TLT, and we have back tested now perfectly to the 61.8% retrace from the sell-off that occurred or that began to occur at the end of August to kind of mid-September. So yeah, I mean, here we are at kind of the important inflection point. Let's see what happens to bonds, and not too much to add here. If we go above, then maybe like gold, we might actually be looking for one higher high to finish off the actual fifth wave here, and then this would end up being 3-4, something like that. But I would put that as a relatively low. Maybe 30-70, 60-40, or 30-70, 40-60 odds. But we're at a very important fib retrace point here, and keep a close eye on that. I do think eventually bonds should move lower, as I mentioned before, bringing us definitely back below where we were at the midpoint in September, likely to that kind of 130 point here on TLT. So anyway, that is where we're at with the update. And then again, too, I should probably finish off with this. And then at that point, and I think I mentioned this during the last update, the big question would be, from there, what do we make of the chart pattern that is emerging? Are we going to go super deep? It seems at this point like a diminishing possibility, as it does look like the end of the cycle might not be too far down the line. However, maybe it is, and maybe that is what emerges, but we will we'll make more of that as we kind of see what happens at the kind of current inflection point. So anyway, that is where I'm going to wrap it up this evening. Good trading for the rest of the week. Expect some potential turbulence, but again, I think as we roll into next week, probably by the end of the next week, I would suspect the bottom would be in at that point, and we would start churning higher into what I think will likely be a Santa Claus rally into the end of the year. So that's it. Good trading, everyone, and we'll see you next time. Bye-bye.